Hi, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Toronto, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Today, I wanted to use today's video to make sure that we cover the ins and outs of owning rental properties in Canada in your personal name, the tax implication from the sale, the tax implication on claiming rental income, the tax implication on claiming CCA. There's so much to cover. But before I get started, make sure that you give us a thumbs up if you like our video. If you have questions, make sure that you leave in the comment section below and I'll try my best to get back to you as soon as I can. And if you find the video useful, make sure that you share with your friends and families. And with that, let's get started. How rental income is being taxed in Canada is really driven by the ownership structure that you have with the property. So in Canada, there are many different forms of ownership. The first one is corporation. Second one is personal. Third one is joint venture. And then fourth one is a limited partnership and general partnership type of ownership. Fifth one is partnership, usually a smaller scale, and LPGP is part of this partnership type. The sixth one is the real estate investment trust, and the last one is the family trust. Now, the most important part is to focus on corporation and personal. I'll explain why. The reason why we have to focus on corporation or personal is typically joint venture is being formed between two parties, and the two parties would typically be either the corporation or personal. So ultimately, the corporation being one of the joint venture partner would then have to report the proportional share of income and expenses, assets and liability. If the person is being one of the joint venture partner, the person would have reporting responsibility. So ultimately, joint venture, it's still going back to corporation and personal. LPGP, similar result. If you are an investment partner of a limited partnership deal, typically if you invest in your personal name, then you are one of the limited partner, and at the end of the year, you would receive a T5013 slip from the limited partnership, and that T5013 slip would then be reported on your personal tax return. Ultimately, if the investment entity is personal name, the individual, the personal tax return has to be having all these reporting requirements. Same with partnership. Partnership is slightly different from joint venture, but extremely similar to each other, but they are completely different. And again, ultimately, if the corporation form a partnership, the corporation form a partnership with a different entity, then the corporation would have the reporting responsibility. And again, this is the reason why we're focusing on personal tax implication on owning a rental property in Canada, and also corporation on owning a rental property in Canada. Lastly, family trust. Even though family trust fall under a different category, if the family trust were to own a rental property on its own, if you ever retain any income being reported by the family trust, chances are the family trust would have to pay the highest marginal tax rate, and the highest marginal tax rate is 53.5% in Ontario. And typically, the trustee who wants to save tax would want to distribute all the income back to the beneficiaries. If the beneficiary of the family trust is the personal individual, then again, it goes back to the individual reporting the trust income. If the beneficiary is the corporation, then the corporation would have to report the rental income. Even though there are so many different forms of owning real estate rentals in Canada, at the end of the day, we're only going to focus on corporation and personal ownership. Okay, CRA accepts two bases of reporting. One is cash basis. The second one is accrual basis. What do these really mean? Well, cash basis really mean that you're eligible to report your rental income as you receive the income, and you're also eligible to deduct the expenses as you pay for the expenses. And the only time that CRA would accept cash basis of reporting on your rental income is if you have no rental receivable outstanding at the end of the year and no payable outstanding at the end of the year. And the second criteria is also for CRA to accept cash basis of reporting is that if you are reporting on a similar basis every year, there's very little changes in your rental operation year over year, they would also allow you to report your rental income on the cash cash basis. Now you may wonder, well, I do this all the time. I issue the payment, I collect rent. Of course, I'm always reporting on cash basis. There is some differences between cash basis and accrual basis. The biggest thing is that cash basis is based on the cash payment, cash receipt. So if you collect deposit from your tenant, 1 month or 3 months deposit ahead of time, what it means is that you have to report that 3 months of deposit that you've received as your rental income immediately, the moment that you receive it. So it makes a difference. For some of the landlords out there, if you are renting your properties to people who offer to pay you 12 months of rent in advance, that means you have to report that 12 months of full rent in your current year, which will provide a very inconsistent year-over-year type of reporting. And it could potentially increase your risk of being audited. Now, sometimes you may think, oh, cash basis sucks because I have to report income in advance, but you also get to deduct the expenses in advance as well. Now, using an example, if your property insurance is being renewed at the end of the year in December, and you pay in December for the full year, you get to deduct that expense the year that you incur it. So you may be 12 months ahead, especially for year one when you purchase a property halfway through the year. Now, what's accrual basis? Accrual basis of accounting, which is what majority of the businesses out there are operating under, is basically you are reporting income as you earn them, and you are deducting expenses as you accrue them, as it's being expensed. What it really means is that, using rental property as an example, you may sign a lease and you're supposed to collect 12 months of rent. You have to report 12 months of rent. It may mean that even if you have not received the income from your tenants, because they are 2 months behind, you would still be required to report that 12 months of rental income. This is called accrual basis because you've earned, based on your contract, that you've earned 12 months of expense. Now, similarly, on the opposite side, the property tax side, if you choose not to pay property tax for the full year, for whatever reason, you choose not to pay the property tax for the full year, and it happens. If you choose not to pay property tax for the full year, but because the property tax in 2023 still happens regardless whether you fully pay for them or not, it would still be charged to you. And so you are eligible to claim the property tax even though you haven't paid for it for the full year. You could still claim it to offset against your rental income that you are expected to collect. Now, for those of you who may wonder, hey, I haven't collected the 2 months rent, why would I need to report that as income? Well, CRA does allow you to deduct bad debt expense or provision for bad debt if you're thinking that you would not be able to collect the 2 months of rent subsequent to year end. But the way that is being reported is it has to be on an accrual basis. As you earn them, you have the right to collect them, you have to report it under the accrual basis. So, in summary, you have to decide the type of basis, accounting basis for reporting, then you can gather all your information and do your compilation to come up with the statement of rental income and expenses. Okay, now we're finally ready to report our rental income and expenses. Today, we're going to only focus on the personal income tax side, and when you received rental income, and assuming you're using accrual basis, which is universally adopted by many people and many businesses as well, when you receive the income, you're supposed to report your rental income on this form called T776 on your personal tax return. And you're also eligible to deduct a bunch of expenses, any expenses that you incur for the purpose of earning the rental income, subject to a list of exceptions specified by CRA. You would be eligible to deduct all these expenses. You're only being taxed on the net amount after you deduct all the eligible expenses. And you're always welcome to watch the other video there to discuss in detail what are the top tax deductions for earning rental income in Canada. Now, when you come up with the net rental income, you're only being subject to tax on the net rental income amount. You can report income in your personal name, and net rental income is taxed as just regular income. Now, using an example, if you already make $100,000 from your day job, a lot of you guys are out there making good money, additional rental income will be subject to 33% and up. So for those of you who don't know, personal income tax in Canada, we're operating on this progressive tax system, which means that the more income that you earn, the higher the tax rate would be. So if you've already earned $100,000 from your day job, and any additional net rental income would be subject to the higher marginal tax rate that's applicable to that tax bracket. If you've already earned $100,000 from your day job, any additional rental income would be taxed at 33%, I mentioned earlier. But if you've already made $150,000, you're the high income earner, and you make $150,000 from your day job, additional rental income will be taxed at a higher rate, 45% and up. Sucks. That's what I mean by progressive tax system. The more you earn, the more you get charged. Now, you also have the option to claim capital cost allowance, which is a tax deferral mechanism that CRA allows you to claim against the wear and tear of the property. And if you want to learn more about this capital cost allowance, make sure that you also visit this other video. Now, you get allowed to claim capital cost allowance to lower your net rental income to zero. You cannot use it to create a rental loss. So potentially, if you report $10,000 of net rental income, you would be able to use capital cost allowance to offset that $10,000 net rental income and reduce it to zero, meaning that you do not pay any personal income tax on it. So the 33% that I mentioned earlier, if you earn $100,000 rental income, 45% that I mentioned earlier, if you earn $150,000 from your job income already, so those would not be applicable if you choose to claim capital cost allowance. But if you incur a net rental loss, which can be in the case this in 2023 and maybe sometimes in 2022, in some cases in 2022 as well, because the interest rate has risen substantially over the last little while. And if you're incurring a loss from your rental portfolio, the loss that you've incurred, you would be able to use that losses to offset against your regular employment income as well. So if you already make $100,000 from your paycheck, and assuming your employer has withhold sufficient amount of taxes for you and send it to the government on behalf of you, let's say you incur $10,000 losses from your rental portfolio, the $10,000 that you incur would give you a 34% tax refund. So if you incur $10,000 loss, that means you are getting a $3,400 of tax refund, assuming that your employer deduct expenses, deduct the taxes on the $100,000 job income sufficiently. Now, if you already make $150,000, the other example earlier, and you incur the same amount of $10,000 losses, that $10,000 rental loss could be used to offset against the $150,000 job income that you have, and that $10,000 loss would give you a refund of $4,341. So yes, the more money that you make, the more tax you would have to pay. But if you incur a loss from your rental portfolio, you would be able to offset against your other source of income in your personal tax return and yielding a higher amount of tax refund. Now, if you incur net rental income, you're not allowed to use capital cost allowance that I mentioned earlier to create a bigger loss. And so you would not be creating a negative $20,000 as a result. You would not even be allowed to claim capital cost allowance. Now, for those of you who earn rental income in a corporation, rental income is considered specified investment business income. And what it really means is that it's subject to a higher tax rate of 50% and 30% is refundable when you declare a taxable dividend. It gets way more complicated, and therefore we're going to create another video to talk about the tax implication when you own rental properties in a corporation in Canada. And stay tuned. So if you haven't subscribed, make sure you hit the subscribe button. Okay. Now, the second source of income by owning rental properties is selling the rental properties. And when you sell rental properties, there are two streams of income that you may potentially be adding to your personal tax return. Now, the first one is called the profit from the sale of the property. If you were to sell the property for a profit, you would then have to report that profit on your personal income tax return. And depending on the duration that you've owned the property and your intention, as well as 12 other factors, you would then be concluded in terms of how to treat that sale, the profit, the capital gain, the profit that you've made from selling the property. Just so we all know, the sale of a rental property, the profit that you make is not necessarily tax-free or just because you live in there. Also, that the second common misconception is that just because you have sold a property, the sale of the property is automatically capital gain. Those are all misconceptions. It really goes back to the transaction and your behavior and your intention. Earlier this year, as of January 1st, 2023, CRA just introduced this anti-flipping rule, essentially basically drawing a bright line test. If you've owned your rental property for less than 365 days and you're making money you're making a profit, the profit that you made from selling the property would be considered 100% taxable. So 100% of the profit would be added to your personal income tax return. If it is longer than 365 days, there is a list of criteria that they look at. The 12 criteria that they look at, you could always refer back to the anti-flipping rule video up above to get a better understanding of how they consider and evaluate the sale of the property, whether they should be reported on the income side or on the capital gain side. And just always remember, if you're reporting on the income side, meaning that you're operating as a business, and 100% of the profit is taxable, and 100% of the losses could also be used to offset against other income. If you report on the capital side, that means profit that you make from selling the property is only 50% taxable, and the losses that you've incurred for selling the property, if there is any, would be also 50% deductible against capital gain that you've earned in the last 3 years or capital gain that you could earn in the future. So now that I've gone through a ramble of how this would work, let's use an example to explain. Let's say that you make a $100,000 job income, which we mentioned earlier. We always use this $100,000 job income as the baseline. You made another $50,000 from the sale of your rental property. Now, if you sell it within 365 days, which means that you would have to report the entire $50,000 as your income. That means now all of a sudden, instead of just having $100,000 employment income on your personal tax return, now you have an additional $50,000 added as taxable income. So now you have a total of $150,000. Now that $150,000, that additional $50,000 means that you would be required to pay a tax bill of $21,250. $21,250. Now, on the other hand, if you incur a loss on selling this particular property, and if it is determined that you are essentially trading properties as a business, then you would be able to claim that $50,000 to offset against your employment income. Now, using the similar example, if you incur the $50,000 loss, and the $50,000 loss will be used to offset against your $100,000 job income, and all of a sudden, instead of $100,000 job income, you now have $100,000 job income, subtract $50,000 business loss, now your taxable income is net $50,000. So if you think about it, that $50,000 loss would give you a tax refund of about $15,000. So that's a benefit of reporting it on the business side. The profit would be 100% taxable, but then the losses would be 100% deductible. Let's say you don't think you are operating a business at all. You are really operating, you are really investing for the long term, and you are doing capital investing. So the sale from the property, profit that you make, the $50,000 that you make, would then be treated as capital gain. If you treat it as capital gain, the $50,000 that you've made, half of it would be taxable. So only $25,000 is taxable. So with $100,000 job income that you've already had, you have to add another $25,000 instead of $150,000 under the business income side. Now you have $125,000 taxable income on your personal income tax return. Now, this $25,000 capital gain would result in roughly about $10,000 of capital gain tax. Now, if you compare the amounts that you would have to pay between the business side when you report 100% business income full $50,000 being reported, you would have paid $21,250. If you report capital side, you only need to pay $10,000. There's a delta more than double in terms of the tax that you would have to pay. So it matters. If it is gain, you always want to call it capital gain. If it is loss, you always want to call it business loss. But CRA doesn't really allow you to pick and choose based on the result of the sale of the investment. It's really based on the pattern of behavior, the 12 criteria that I mentioned in the other video. So make sure you visit the other video to find out. What if you incur a loss and the loss is considered capital loss? Well, the capital loss would then be reported on your personal income tax return. In the same year, if you have any capital gain from the sale of any of your capital investment, you can use it to offset against that capital gain, and you don't pay tax on the capital loss amount. Now, if you don't have any capital gain reported, you cannot use the net capital loss to offset against your regular income. If you have $100,000 job income, you incur capital loss of about $50,000, net capital loss would be $25,000. That $25,000 would have no impact on your personal income tax return at all. You would not be able to use that loss to offset against your $100,000 employment income. There is absolutely zero tax refund as a result. So it's also important to understand your pattern of behavior. You would be able to utilize that capital loss if you have capital gain realized over the last 3 years, or you would be able to carry the capital loss forward indefinitely until the moment that you have capital gain realized, and you can use this capital loss to carry to offset against the capital gain that you report in the future. And last thing about selling the property, there is something called recapture and terminal loss. Remember earlier on we mentioned that you would be able to deduct capital cost allowance, which is the wear and tear of the property, against the net rental income and deferring the taxes out. Well, capital cost allowance is a tax deferral, which really means that you're not paying taxes on the net rental income the year that you receive it. You're using it to using capital cost allowance to offset against that net rental income, and for whatever amount that you've claimed as capital cost allowance, short form CCA, you would have to take it back into income the year that you sell the property. So when you sell the property, if you've ever claimed any capital cost allowance, and more often than not, we have to go back to the year, every single year, and see how much you've claimed over the years to determine how much capital cost allowance you've claimed. And we add them all up, and at the end of the day, we realize maybe you've claimed $10,000 capital cost allowance. Then that $10,000 capital cost allowance that you've claimed over the years would have to be added back to income as regular income. It's not capital gain, because if you not claim capital cost allowance originally, it would have been taxed as net rental income. Now you're required to take all the capital cost allowance as income the year that you sell the property, so it's still considered income. 100% of it is taxable. So it's kind of similar to RSP in a sense. The contribution to RSP is not taxable. So when you claim CCA, it is not taxable, but when you withdraw from RSP income is being added. So when you sell the property, the CCA you've claimed would have to be taxable. So similar to RSP. If you have a loss, and there are times that this recapture income as a result of claiming all CCA that you've claimed back to your income, call that recapture income. Now, sometimes you don't have recapture income. Sometimes if you are losing so much money from selling the property, none of this recapture income would have to be reported back to income. So what it really means is that there is something called terminal loss on your tax return. It could be triggered if you sell the property in such a low number that the property was sold even below the amount that you haven't claimed the capital cost allowance on, and you would be able to claim further terminal loss. And terminal loss is kind of like net rental loss. You could use it to offset against any any employment income on your personal tax return as well. And sometimes in certain situations, if you sell your property above the undepreciated amount, you may still trigger recapture. But anytime when you are selling below your purchase amount, chances are there is some recapture income or some terminal loss. If you've ever claimed any terminal loss, you would not be able to claim capital loss. Yes, the tax law can get complicated even for as simple as a rental income property. Now that we've covered all the ins and outs and everything and all the tax implication that you've imagined for owning a rental property in Canada, maybe you're super excited or not so excited about buying another rental property. But before you go, make sure that you hit the subscribe button and give us a thumbs up if you like our video. Until next time, happy Canadian real estate investing.